Hey guys, welcome to Trading with Dan. I am Dan. Nice to meet you all. So this is my Trading with Dan School of Trading, and today we are going to look at the science of chaos. So chaos theory. What is chaos theory, and what are chaotic systems? So chaotic systems exist in many natural systems, in many places in the natural world, as well as also many artificial systems, so such as stock markets, and this is why chaos theory is important to understand, because of how it does impact stock markets. So one of the main aspects of a chaotic system is that a very small change in any of the inputs can result in a very large change in the actual outcome. So say for example, there's the butterfly effect that many people will know about, many people have heard of, and what that basically tells us is that a butterfly that flaps his wings, changes direction, sets off a little air current, which then triggers a slightly larger air current, which then triggers a larger air current, and then over a period of time, it then results in a hurricane, like say the opposite side of our side of the ocean. So that is an example of how just a small change in the environment, in the wind patterns caused by a butterfly's wings, results in a very large, basically a very large outcome. So one thing that you need to understand about chaotic systems is that chaotic systems doesn't mean random and randomness. So they are, whilst it may seem random, they are underlying patterns and feedback loops that sort of cause what the result is, and it isn't just caused by say coin tosses and random results. So because of this, obviously on a larger time frame, the outcomes of chaotic systems such as weather patterns, the flow of a river, or the direction or price of stock markets, the larger the time frame, so the further into the future you want to predict where it's going to be, the harder that will be, because of all the inputs that even any individual small one can make a massive difference in what will be the end result. So what happens in a chaotic system is that it will often follow the path of least resistance. So in much the same way a river flowing down a mountain will follow what is the path of least resistance. It won't follow where the river wants to go. It will just follow where it is easiest for the river to go. So this is the same in financial markets. It won't necessarily go where the market doesn't go where it wants to go or where any individual people want it to go, but it will just go on where is the least resistance. So it will just go in the direction that it's easier for it to go into. It's obviously not gonna go in a direction that it's harder for it to go to. So this direction, so in much the same way the direction a river may flow is determined by the sort of the underlying rock structures, the gradient of the landscape, those things, the depth of the river. These same things apply to financial markets. So there'll be many factors such as just the flow of money, interest rates, black swan events, wars, things going across the world. All of these things will have an impact on where the market goes, and the market just isn't going where the market wants to go. And then a lot of these factors are unseen structures. So they're things that you don't necessarily aren't apparent to the naked eye. So things that drive financial markets are not things that you're necessarily going to know are driving them. In much the same way, the things that determine the direction a river flows are not things that the river knows or decides on. So when a market or when a river, financial market, changes direction, or when a river changes direction, that change in direction is what is known as a fractal. So if we want to look at that on a chart, which we will do in a moment, a fractal on a chart is a point where we have a change in the trend. So typically, to draw this on a chart, we would need a minimum of five bars or candles. So you'll have to have two candles that are both lower than the third candle, and then two candles after that third candle that are then both lower than the third candle. So you in effect get like a peak in the market. So, and that is called a fractal, and that was where the trend changed from. It was going up, it topped out, and then it went down. So what a fractal will show us is the point that we have the trend change, and then that new trend change direction of that trend will be the new path of least resistance. So an interesting thing about fractals is that they will work the same on all time frames. So you can try this. If you look at a chart on, say, the 15-minute or the hour, or then on the day, it is hard unless you know the time frame that it is, unless you've got it there on the scale, to actually know what time frame it is just by looking at the chart. There's no way you can look at the movements of a daily chart and know that, well, that's a daily chart rather than like a 5-minute chart. So fractals basically work on all time frames. So right, so we're going to look at an example on a chart. So you can see here we have to have a minimum of 5 candles. In this example, we actually have 6 candles, because these two candles, because their high is the same, they will count as basically the same one. So we'll have a candle here, the market then goes up a bit. So we have a second candle, the market then goes up a bit more, and we have the third candle. So the next candle, the high of that candle is equal to the candle before. So we're then going to look at where the next candle goes. So the next candle then goes down. So we get the 4. So what happens now, if that next candle number 5, if that high was higher than number 4, we wouldn't actually have the bifractal, because what we needed is 2 candles that are both lower than each other and both lower than the candle before to get a bifractal. So, but in this instance, the 5 candle is lower than the 4 candle. The high of the 5 high candle is lower than the high of the 4 candle. So we have completed the fractal, and the bifractal level is this line that we can see here in green. Right, so conversely, carrying on with this price action, we then form a sell fractal just here. So this sell fractal doesn't take 6 candles. This candle here isn't equally low as either of those. So that is a 3 candle, a sell fractal candle in its own right. It's not joined with another one. It's not the same level as this. So these are both the three. Well, they would actually both be the 2 candle, but so we have the candle lower than the one before. We then have this candle number 2, where its low is lower than candle number 1. We then have candle number 3, which is the low is lower than candle number 2. We then have candle number 4, whose low is higher than the low of candle number 3. And we then have candle number 5, whose low is lower than candle number 4 and 3. So that's the 5 candles that completes the sell fractal. So this line here would be the sell fractal level. Right, so we have the bifractal. We had the bifractal, we had the sell fractal. So then what happened now? The market kept on going up, and this candle here, so if you wanted to keep numbering from here, that would be candle number 6. It actually goes higher than this bifractal level. So based on a fractal trading system, you now have a buy trade at this level here. So as the candle crosses that level, you will then buy, and you will now be in a long trade. And then what actually happens is that will then negate the sell trade. So say the market then started to come down and we went below here, we wouldn't necessarily sell. We wouldn't sell here based on a fractal trading system, just because we've gone lower in this fractal. We have to then wait for a new sell fractal to form, then the market to then go lower than that new sell fractal for then to have a new sell trade. Right, so as you can see, if you trade based on fractals, what you are in effect doing is you're going with the flow of the market. So you're taking trades based on if you're taking trades based on the fractal rules, you are actually ruling out possibilities of fighting the market. So you're not going to be trying to call the bottom or call the top, and then it goes down some more, so you buy some more, and then it goes down some more. That's not going to happen. So it is in effect sort of a breakout trading strategy. So yeah, so where you are going with the flow of the market, you're following the path of least resistance. What this can help you do, it can obviously not only help you enter good trades, it can help you then run the profits on those trades. So you've got the best opportunity to maximize the gains from a particular move or trade you're in. So what can happen then is you can make big profits, and even if you don't make them very often, but you do capture the big moves, then you will still be profitable even if you have lots of smaller losing trades. So there is one thing you do need to watch out with this, and that's obviously double tops and double bottoms, where you can see you will end up with a buy signal and it is a double top. But obviously with any trading strategy or any system, it's not going to be 100% successful with no flaws. I mean, that's obviously impossible. There is no formula to solve the markets, is there? So going back to our example, we had the buy fractal here, we had the sell fractal, then market took out the high, that took out that buy fractal level, and then so that got us now buy signal, and then look, we had this great rally up. So that was a great trade, and obviously there was no point where you're going to be looking to get out of that trade. You're just running the profits of that trade. So we need to discuss another aspect of how chaos theory pertains to markets and economics, and how people often have like the wrong idea and a wrong concept, a wrong theory of it. So equilibrium theory in economics is based on a false analogy of equilibrium theory within physics, like more specifically Newtonian physics and objects and movement. So how objects move in the physical world, they move irrelevant to any sort of thought process where they want to go. They just go, follow the path of least resistance. The trend is your friend, and this is obviously different to how financial markets work. So because financial markets are obviously greatly impacted by what people think. So that's not the same as in the physical world. So if you are going to then look at how things move, how things can tend to equilibrium in the physical world, then it's not gonna help you understand markets that are actually driven by what people think. So a good example of this is say I always like the roulette examples, because roulette is like it's like probabilities and taking risks, the same as trading is. But I always find it's a good way to compare different sorts of probabilities. So so let's talk about how, if you are playing roulette and say you're playing for black and reds, and say red comes out 8 times in a row. So that does not the fact it's come out 8 times in a row doesn't mean it's more likely that the ball is then gonna fall on a black the next time. So what has happened before, the outcomes and results of where the ball landed before has no relevance, no impact on where the ball is going to land the next time. It doesn't mean we're more likely to land on black, but I mean you can obviously understand how many people that will go play roulette will see say 8 reds in a row and think, oh, I've got to go and bet on black now, because it's got to come out. It's gone out on red so many times, and then so they're making a conscious decision based on what they think is more likely, which actually the actual physical world it will have no impact on that. So it's sort of completely irrational, isn't it? As you can see. So what happens is markets will try to predict the future, where markets will go, try and predict the future based on what people think now. So say a market is going up, that will make people think that, oh, the market's going to keep going up, so they'll then buy the market, and then buying the market will then make the market go up, and then make other people and themselves think the market's going to keep going up even more, so then more people will then buy that market, and then the market will then keep on going up. So this sort of feedback loop is what George Soros calls reflexivity. So the more people think something will happen, they then there's like a call to action, and then that will then further drive what is happening, which will then further drive what is happening, influence decisions to then further drive what's happening. So I mean, at the moment you can see this is happening in the Tesla share price. It's going up, so more and more people are thinking, well, this is going to keep going up, so they buy, and then more people see that then going up even more, and they think, right, so I'm going to buy, and yeah, so we sort of have a feedback loop, which means that market then keeps going up. So as you can see, that is vastly different to playing roulette, where say you just obviously completely at random, you have say 3 reds, so the market, the balls are coming out the same color, much in the same way a market is going in the same direction. It does not mean the next ball is more likely to be a red, but obviously in markets, people see the market keep on going up, and that will then encourage them to buy, which does actually increase the probability of the market going up, and that is why the trend is your friend, because of that reflexivity in markets. So lots of indicators that people will use, like they tend to be like reversion to mean indicators. They're like sort of telling us like prices move too far in a certain direction, it can't keep going that way, it's got to come back. So things like the relative strength is obviously massively overbought in Tesla on many time frames, but that at no point so far as that meant the price is not going to keep going up, and then we're getting further and further away from the moving average, but that doesn't mean that the price isn't going to keep going further from the moving average. So sort of, if you think about chaos theory, there is no real concept of overbought or oversold. The market will just keep going that way until it doesn't, just based on the path of least resistance. Right, so that brings us to let's look at some aspects of trading. Let's look at some factors that will influence when you actually want to be in a trade. Right, so number 1, a great time to be in a trade would be when I can make the most amount of money in the least amount of time. So I mean, that's a nice thing to say, but obviously identifying the point in time when you can be take a position to make the most amount of money in the least amount of time, that's obviously the hard part, isn't it? And that's what we're trying to look at with chaos theory, and understanding that, so we can try and find those opportunities. So when these times can often be is when volatility is increasing, and then ranges are expanding, so price is moving in a direction at an increasing amount. So then it's likely to keep going in that direction. So what happens when that happens? When volatility is increasing and ranges are expanding, that means the odds then will increase with the direction that the market is moving in, will keep moving in that direction. So as volatility is increasing and the market is trending in a certain direction, that will increase the odds that the market will keep moving in that direction, like we were talking about before with reflexivity, and like the underlying feedback loops of how the system works. So what that will result in is a favorable risk to reward. So say a market is breaking out and increasing volatility and going in a direction, then we can buy that market. We can then put our stop like not very far below the current our entry, and then so if we take out that low, we're out of the trade for a small loss, but we've got every chance of making a big reward by the market still moving fast in the direction it was going in. So basically what we are talking about in markets is we are looking for consolidations and then breakouts from those consolidations. So you can see how that does relate back to the fractal trading that we were looking at. We're looking at the market consolidating and then breaking out of that range that it was consolidating in. So a good way that we can look at this with some candlestick analysis is looking for inside bars. So what an inside bar is an inside bar is quite literally a bar that is inside the bar before. So more precisely, it's the highs and lows of the bar. So the high and low of this bar here is inside the range of the high and the low of the bar before. And then what we actually have here is yet another inside bar. So we have a bar here that is the high of this bar, and the low of this bar is inside the high and the low of this bar before, which again was inside the bar before. So what we're having here is a consolidation, a decrease in volatility. Like the range of this bar is obviously wider than the range of this bar, which is then wider than this, which is then obviously wider than what the range of this bar is. So we're having a decrease in volatility. So then this is setting us up for an increase in volatility. So lower volatility will lead to higher volatility, and then higher volatility leads to lower volatility. So right, what we can see then. So these are those three bars we were looking at. This is the same chart we were looking at before. We had this was our fractal high. This was our fractal low. Well, it was our fractal low once this bar was formed. We had to wait for this bar to be formed. So we had the 5 bars that meant this was the fractal low. But ignoring that and just looking at these 3 candles here. Sorry, not those 3. These candles here. This is showing us that this decrease in volatility, we have now broken out over the top of this candle, and then what we have then is an increase in volatility. So once we break out of the range in the next candle, we then carried on going upwards. So it's a bit confusing here. So as you can see, we had this candle here and this candle there, but this candle obviously was initially within the range of this candle, but it then broke out the range. So we had this candle was inside this one. This one obviously wasn't inside this one, but this candle, as it was forming, was inside this candle here. We had the low, we had the high, and then it went to a new high, which broke above the high of this candle here. So we then had a breakout, we had an increase in volatility, and then we got exactly what we wanted in this case. The price carrying on going in that direction and increasing its range, increasing its volatility. So this level here was a great level to buy at. So the break of this candle was a great level to buy at. So one thing we do need to understand though, one caveat in this is that when we do break out these ranges, we can then get an increase in volatility, increase in the range, but the range doesn't have to be in the same direction. So what can happen is, fair enough, this range was all pretty much upwards in the same direction. You can have a break upwards to break the range and then come all the way down afterwards. So the range does increase, but we actually broke upwards to signal a buy, but we actually then went down afterwards. So that is still an increase in volatility, still an increase of the range, but it wouldn't have been a great trade. And then we would have had to have our stop at the low of the candle, so we would have entered this trade. So you can see, it was a good risk-reward trade, even if we didn't have this rally and we just went up and then took out the bottom, because that was our risk, this level here. And as you can see, our gain potentially was this much or higher, which was higher than the risk. So obviously in hindsight we can see that. I mean, if this had just taken us out, that would have been our loss, and we wouldn't have known that would have been our reward. But when you have the increase in volatility, working on the laws of probabilities, that is then going to keep going in that direction. Overall, it is going to result in more winning trades than losing trades. So more often when we do break out of a range, we'll keep going in that direction before we then actually take out basically the low of the candle, which then would be our stop. Right, so I think I went on a bit too much there about that. So carrying on with the trade. So as you can see, this analysis of the volatility and the inside candles we had here actually got us a better entry into the trade than waiting for the actual fractal. Um, but that still was chaos theory. This low volatility leading to high volatility, and then it carrying on in that direction through the reflexivity, the feedback loop. Still is all part of the science of chaos. But it's just a way that we could get a better entry in this instance. So we could have bought here. The market then kept going up. We then would have even bought more as we broke the top of the fractal. And then we're now in a great trade, and then that rallies up very well. So then what we have again here, we have another what obviously we know as an inside candle. This is the high and this is the low, and then the next candle, it's high and it is low, is within the high and low of the previous candle. So we have got an inside candle here, and then this new candle as it's forming, it obviously it would have had to have opened here because this was the close of the candle. So we did actually take out the high, so we are looking at an increase in volatility again. So fair enough, we did come back down, but we didn't come and hit our stop and take out the bottom of the candle. And then we did carry on rallying upwards. So this is another example of when you then could have made another entry into this position, into this long trade, based on obviously the reduced volatility then leading to increased volatility. So yeah, so I hope those theories and concepts do help you with your trading, do sort of help you understand why reversions to the mean aren't necessarily the best way to trade. Breakout trading is a great way to trade. It's how I like to trade. Sort of fading moves isn't the only way to trade, isn't the best way to trade, and it kind of shows how the human mind, human psychology sort of can sometimes make you want to fade a move in much the same way that even though when you sit down and think about it, you know a string of reds in the casino at roulette doesn't mean you're more likely to get a black, but your human sort of emotions taken over, like thinking they can impose themselves on the random physical world, are then going to result in it. Oh, well, it's more likely going to be a black this time, so I'll bet on black. So I hope that did help you guys. Yeah, thanks for watching. So this is my YouTube, so if you like these videos, there's plenty more coming, so be sure to subscribe. This is my Twitter, Trading with Dan, my Instagram, Trading with Daniel, and I have Discord and Telegram links in the description. So yeah, finally, and an end note here. Remember, none of this is financial advice. It's just for educational purposes. I'm not a financial advisor. Always consult your financial advisor before making any investments, and especially investing in financial markets can be very risky. So don't invest money that you can't afford to or aren't prepared to lose. So thanks for listening, guys, again, and I will speak to you guys on the next video.